Good evening and welcome again to episode 2 of our masterclass on cap table. What we thought of was our internal training has converted to now an 3 episode series, potentially 4 if we get another topic during the day. My name is Sambhav. I am a general practitioner in startup ecosystem. With me is Akash and Nitin. Maybe you guys can give your introduction.
So I am a practitioner in CS and been working in the startup ecosystem in the compliance and the secretarial domain.
Okay.
I'm
Nitin.
Nitin, and I'm a practicing chartered accountant, specialized into valuations, specifically for startups, and I help them in creating their financial models, raising funds, and all those activities.
So idea of the session was to kind of create a cap table scenario and dissect it and present it in a language which is startup oriented, a mindset and a language that could be understood. We've already done our first episode on 18th of October, in which we covered things like what are the preferred legal structures, what kind of entity you can incorporate, what is share capital, what is cap table, what is kind of percentage which founders should have between themselves. We talked about a trajectory of how fundraising happens, what are the various rounds. We also talked about why CCPS is a preferred tool. We talked about investor preference there, touched upon ESOP. We also touched upon potential percentage which is agreeable at early stage for an ESOP pool, though we have detailed ESOP discussion in our episode 3. We also talked about and touched upon dilution, what is fully diluted cap table and all, and potentially that's what all we covered in our episode 1. If you want to review that, it's almost a similar knowledge, but I think as a USP of that video, which is now on LinkedIn and YouTube as well, is just that the language, when we also went back and kind of reviewed it, it's just that the language is pretty simple for somebody to understand. So if you're finding these nuances a little complicated, go through that video. Be rest assured that at least the basics of cap table would be well understood. So we'll continue those discussion. I think last time, Nitin, Akash, I told an example where we took an example of two-founder company. We talked about Aloo Ka Paratha and the pies that goes along to different stakeholders, ESOP investors. And I took an example of I as an investor investing 50 lakhs in that company for say 10% share and then valuing it at 5 crores. We talked about pre-money, post-money, right? What are the documents that comes perquisite to a valuation report, so legally or a secretarial compliance wise, which kind of defines the relationship of what all financial transaction takes place. So maybe we can start off with you, Akash.
Sure. So I'll just start from a perspective that where the round starts and where it closes, right? So I'll just give a brief snapshot of the whole fundraise, right? And then maybe we can discuss upon that what is in the term sheet, what is in the SHA and SSA. So starting from it goes with the negotiation between the investors and the founders, right? And then once they are basically agreed on the mutual terms, correct? Then the term sheets comes into the picture.
The first document is term sheet.
Correct. So first document is the term sheet, and term sheet is nothing. It is just the understanding between the investors and the founders, right? It is just a paper document, non-binding thing, right? And where all the major terms what have been agreed between the founders and the investors are to be mentioned in the term sheet document. Beyond that, once the term sheet is signed, then SSA and then the agreement basically comes into the picture, right? Depending upon the round that either you are doing first round or say the subsequent round, right? Your investor nomenclature can change, right?
Okay.
Yeah, for the first round you can have say SSHA, right? For the next round you may have say different SSA and the SHA.
So when you say first or second means we're going back to the episode 1. So if we are raising friends and family or say a small angel,
correct.
then you're saying shareholders agreement.
Yes.
Okay.
SSHA, a shares subscription and holder agreement.
One agreement.
Yes.
Okay.
That is a one agreement defining everything because it's a very first round, right? And then when you move to the next round, the investor may ask, or there may be some requirements where the existing investors are not participating in the next round. So you may have say two different agreement, SSA and SHA. SSA basically defines all the commercial terms which have been agreed in the term sheet, right? valuation, price, nature of instrument, right? And then cap table, pre-money cap table, post-money cap table, right? And then the rights of the investors, which they are getting, right? The board seat, preemptive right, offer, all of those things. SHA is basically when the existing investor have agreed for few terms, right? And then there is a new investors which is been coming on picture on board, right? The new investor may have some additional or say the favorable term over the old investors. And that's where the SHA comes into the picture, where SHA covers the rights of existing investors plus the new investors in a one document where all the existing investors plus the new one agrees to what is being agreed with the new investor. So that's where these two agreements comes into the picture.
So what you're saying is in initial rounds, whenever we are looking at only one agreement,
Yeah,
it's primarily whatever you call it. Usually the term out there is shareholders agreement,
correct.
but it's typically SSHA, share subscription and holders agreement.
In the first round, yes.
First round.
Yes.
So irrespective of whether you call it SHA, it will also have subscription terms as well.
Yes. Yes.
Understood.
Yes, that's correct.
So are they? Yeah, go ahead, please.
Yeah.
Nikhil.
Would like to add one point here. I mean, this is general query which has come from founder community. So generally people ask, let's say if we are doing a very small round, say 40-50 lakhs rupees they are raising, do we really need to have those agreements in place? Can't we simply, I mean, issue the shares and get the money? What is the actual requirement of getting into all these nitty-gritties, paying 50,000 to 1 lakh to a lawyer? Legal fees is sunk cost for them. So that's a general question. Now my submission to that question is, things are always good till they are bad.
Absolutely.
Right. So you can always get the money without explaining the terms, without agreeing on certain control matters, reserved matters, and board seat and all those things. But if things don't go your way, there is a chance that there would be some kind of dispute which may arise in future. So to avoid that, it's better to put things in black and white. You can try to put things in black and white. Things would still be gray, but it's better than not putting anything on paper. So that's why these term sheets, SHA, investor agreement, share subscription agreements, all these things make sense.
So have you come across a case where people have directly gone to, they're called definitive agreements, if I'm not wrong, SHA and SSA. So no term sheet, just directly signing the agreement and closing the rounds. Or do you see no term sheet is mandatory, it should always be there? How should it be perceived?
No, it's not mandatory. Likewise, I mentioned, right? So term sheet is nothing. It is just a piece of paper where the oral terms have been agreed, the verbal terms have been agreed between the investor and the founders, right? So it is just a piece of paper where what is being agreed, right, on a table, right, is being written down in a paper form. That's all. So term sheet is not a mandatory document, but so whenever you are doing a say friends and family round, angel round, right, usually term sheet doesn't come to the picture unless there is a ask from the investor specifically. No, I want to see the term sheet first. Otherwise, they just move ahead with the agreement part. Either you call it as investment agreement or SSHA, whatever. Depending upon the nature of instrument, the name of the agreement changes. That's all.
Yes, please go ahead.
So term sheet as Akash explained is just a understanding document. Now think of founders as employees. Think of term sheet as an offer letter from a company. Now what generally employees do, they take an offer letter and then they go to the market once again. Let's say certain things have been agreed with an investor. Investor has agreed to put in 50 lakh rupees for 5 crore post money valuation. Now it's an offer letter. Me as a founder, I will go to the market to the other investor saying that, see, that person is already giving me this much valuation. Would you be able to top it up? Can you give me 6 crore? 6 crore valuation for say again 50 lakhs. So what do you think? The general question is, if you are a Shana founder, you will try and do that, right? Second, similarly, companies can always give you offer letter and then rescind it. They can pull it back. You already heard of these news, where companies have offered a letter and they've not, asked employee to join. So what happens then? Since it's non-binding, I mean, to both the parties, founders as well as fund managers or funds, investors, I have a simple advice. The world is too small for these things. I mean, you do these kind of things and you would be notorious in the market. If you are pulling back those offers after offering it to the founder, then your word has no meaning. That founder in his community will, I mean, spread the word that this investor is not reliable. You as a founder going to the market, I mean, for a better offer, it sets a bad precedent. Again, investor will tell the investor community that this founder is not reliable. Either way, I mean, this will end up kind of damaging the whole ecosystem. So once you agree on term sheet, don't, I mean, go back, on your words. Stick to it.
Here, so we can have questions. So anybody wants to ask, feel free to jump in between. And we have people sitting online also. So happy to take your questions in the comment box. Feel free to drop in your questions. So while you were speaking, one thing that came into my mind was, let's take an example that we were continuing with. We never touched upon term sheet SHAs in our last conversation in episode 1. And I'll continue from the same example that friends and family, I wanted to help my friends or family members, and I've given them 50 lakh rupees, no agreement, nothing of sorts, verbal arrangement, take it as a debt, I can give you convertible note. Now there is a subsequent round shaping up. How will I come into picture as a first or a previous investor in the new term sheet that's getting signed? Because I maybe have done a mistake in previous round of trusting too much because it's a friends and family. Just throw some light on your views on this example. Take all 3 cases. There is a founder, there is an existing investor, and there is an incoming investor. And I have done a mistake of not having an agreement. How should such situation be solved for?
So yeah, the point is that if the founder and the friends who has invested the money just on the face of I'll say the founder, right?
Mm-hmm.
And they have not agreed for any SHA or they have not entered into any agreement, correct? So you can do it. There is a possibility you can do it, but you will not be able to do except the equity shares. These are the common stocks which do not have say any additional rights, right? So equity shares can be issued without say any piece of paper or any agreement, right? But if you have done the round with some other instrument,
so in my case, convertible note, if
right,
so right. You mean that would be something?
Yes, there will need to be something. If you have put the money as the convertible note, right, then you would have agreed for some X terms. Say what will be the floor, what will be the cap, what will be the discount rate, right? So there will be something in return for sure. If you have not done that part also, right, then there is a non-compliance.
Interesting.
Then the founder will need to go back to the previous investors, right? Then let's just do it, because the next investor who is bringing on board, right, or coming on board, they'll always ask for the document, that what all are the terms of the convertible note which you have agreed.
So you're saying there could be a disagreement between existing investor and incoming investor based on whatever term sheet is getting signed.
That's correct.
And that's founder's pedigree to solve for.
That's correct. And that's where your next deal which you are say doing with the new investor, right, may be impacted because your previous investors terms are not clear, right? Because and the next investor may not take a risk where the existing investor create a blocker, right, in the long run for the company and for the founders. So it is always better to have agreement in place, or maybe a term sheet, or maybe a MOU kind of thing, right? So that you are covered from all the perspectives.
Interesting. So let's pick up some pace because I think we have a little technical topics to go through. You talked about floor and cap, so we'll come to that. Before we proceed into what these definitive agreements have as content, we've seen some cases where people have 10 equity shares and then they take other instrument. Why does that happen? Why is that prevailing in the investor ecosystem?
So again, equity shares gives the voting right to the investors, right, to basically get all the notifications of the shareholders meetings which has been happening into the company, while the investor will not get in some other instrument. So that's where and this structure comes at a VC round, right, where the VC who has put the big amount in the company, right, they want to know that what is happening in the shareholders matter. Generally, the shareholders matter are the critical one, then the board matters, right? And that's where the VC and the institutional investor wants to have the notification or say the intimation of all those matters which are going into the shareholders meeting.
Interesting.
Yeah.
So let's now move on to the definitive agreement.
Correct.
And when we do, I think we'll touch upon valuation also, that what are the key terms in these definitive agreements which affect our valuation. So maybe you can just bifurcate key modules that exist in these SHA or SSAs in 2 or 3 segments. And then let's just talk about what are those relevant clauses, some of them, which you can throw your light on, which does not have impact on valuation, but maybe say on control. And then maybe we'll move to Nitin on those clauses that have impact on pricing or valuations.
Yeah.
Over to you.
So to start this, so depending upon the round, right? Depending upon the round, your name of the agreement changes.
Okay.
Correct. If you are doing first round, you can have SSHA.
Yeah,
Depending upon the round and depending upon the instrument also. If you are doing convertible note, then you may have convertible note agreement. If you are doing the say iSafe, then you may have iSafe agreement, right? So depending upon the round and the instrument, the nature of or say the nomenclature of the agreement changes. However, the major terms are almost same in all of these agreements except the convertible note, right? So when we talk about the rights and the terms under these agreements, so these are primarily divided into 2 parts. One is economic rights, where these are the rights which can have impact on your capital.
Okay.
Right. And then the second one is the controlling rights, which may not have or say which may not visible on the capital, but can have the background control rights, which can at the end can affect the capital also.
So economic could be quantitative and the other side is qualitative.
That's correct. That's correct. So when we talk about the economic rights, right? So again, so it will basically have the price, right? What are the commercial rights? So the agreement will have price per share. The agreement will talk about valuation. The agreement will talk about the nature of instrument, the number of instruments, right, which are going to be issued. Correct. The price needs to be defined in the agreement. Correct. Then we come with say pro-rata rights or say preemptive rights. So these are the right. So preemptive is basically the broader terms which include the pro-rata also. So preemptive basically gives the existing investor a right with an option to subscribe in the additional shares of the company.
Okay.
As in when, so likewise, in the previous example, you have put the money in my company as a first investor.
Right.
Now I am raising another round and you have signed SSHA with me where you are holding preemptive right.
So I have a preemptive right.
Yes.
Okay.
So you have preemptive right? So now I am onboarding new investor, correct? And that's where if I am offering new securities to that new investor, right? So I'll need to offer that first to you.
So I have a kind of first refusal.
So first refusal is again, so more or less these are the similar rights and technically we will need to go into that.
So you need to ask me, but I have a option to say no, that I don't want to invest in this round.
That's correct.
So that's preemptive. Right?
Correct.
Yeah.
So preemptive right will be offered on the very same terms on which I am raising the funds from the new investors, right? Again, this is a right to you. This is not an obligation that you will need to subscribe. No. Again, the pro-rata is a part of this, right? So pro-rata is when you want to maintain your same shareholding in the next round also.
Okay.
Then you will be allowed to subscribe on the same terms, right? To maintain your same percentage as you were holding before the new investor coming on board.
Okay.
Yeah. So we talk about preemptive, pro-rata, right? Then there are ROFO, ROFR, right? Right of first refusal, right of first offer.
Okay.
So again, these are the commercial or these are the economic rights, correct? So preemptive, we talk about ROFO and ROFR is where the selling, so assume they are the existing to investors in the company or they are the founders, right? Now, either of them want to sell their shares, right? And then you are the investor in the company. You are the third investor in the company. The other two wants to sell. And you are holding that ROFO or say ROFR, right? Let's just talk about ROFR first.
I'll have either of the two.
You will have either of the two.
And
Correct.
one would be with the founder.
One
Is what
would
I'm
be-
assuming. Yeah.
That's correct. So your agreement will not, generally the agreement doesn't talk about both the things, ROFO and ROFR. You will see one of them, right? So ROFR is more technical for the founders, right? ROFO is more favorable for in favor of the company. Why it is so? So let's just put an example, right? So there are there are four shareholders in the company. One of them wants to sell his shares, right? So that person will need to offer, in case the other investor are holding ROFR, right? That person will need to offer the shares, right, to
The other investor.
To the other investors.
So in my
correct,
case,
at a determined price.
Understood.
So in ROFR, there is a price discovery which is being done at correct, at the person who is been selling the shares, right? So that person will need to give an offer, right, to the other shareholders in the company. If they want to accept, they can accept or they refuse it.
Understood.
So this is called right of first refusal. Right of first offer is more or less similar. It is just that I will not do a price discovery in this, right?
Okay.
I will just offer it to you that I want to sell my share. You tell me that at what price you want to purchase it.
So price discovery is post. In the other case, it's pre.
Correct.
Okay.
Correct. That's correct. So these are the thing, and then we talk about, say, non-compete clause in these agreement, right, where the investor want to protect their rights and put some restrictions so that the founder or say the existing holders do not engage with the similar activities with some other entity.
So is that investor giving it to the founder or protect a kind of indemnifying founder that I will not do it, or is it both ways?
So you are talking about non-compete.
Non-compete.
No, it is from the investor to the founder.
Okay, so founder cannot do it.
Yes.
But as an investor, can I do it?
Of course. Who will stop you?
Yeah. So I've come across few use cases of investor disputes where we've seen investor investing and then entering into a competition.
Yes.
So my question was more from a practical point, that is it time where in the ecosystem we start spreading this noise also that, okay, have a non-compete clause in the agreement that as a founder you will not compete with yourself in future.
Yeah.
But what if investors compete? I don't know if you have come across cases.
Yeah, we have come across where the investor first invested in the company and then brought his son to the company, right, as an employee, and then he basically created his company into the similar domain.
Got it.
So we have come across with all of these cases, and this is the exceptional cases, right? And these cases mostly go into disputes.
Got it. So maybe you can continue.
So so I was talking about the economic rights and then the controlling right, which you may see in the agreement, and these are more important for the founders also to understand that you should not just see the valuation and you should not just see the investment. You should also see what all are the rights which you are agreeing to. Because as Nitin mentioned, right, agreements are for the bad times. So they are board rights, whether you want to give it to the investor or not, right? They are, say, drag along rights. Drag along is basically giving the power to the majority shareholder, right, to basically club the minority shareholder with them in a potential deal.
Acquisition or a merger.
Correct,
okay.
correct.
Sell out.
And then there is a tag along right, where the minority shareholder basically asks the majority shareholder to bring them
on board
onto that deal, so that the proportionate whatever the majority shareholder has been selling in the round, right? The minority shareholder also get the proportionate right to sell. Then we have affirmative votes, right? Again, these are the controlling rights. Affirmative matters are what? These are the matters where the investor wants his permission before you go to the board, or you basically takes that matter into action. So affirmative right, हम इसको affirmative भी बोलते हैं, हम इसको reserve matter भी बोलते हैं, right? So they will be, you may see, and all of these rights comes into the bigger round, where the investor have put the bigger ticket, right? And he want to safeguard his interest from all the ends. So reserve matter are basically, these are the rights where say merger is just for an example, right? So it may have a say 10-20 rights in the reserve matter, But again, talking about few of one, like if there is some merger happening in the company, right? So the investor want to have the prior intimation or say prior permission for the founders to get from the investor.
Mhm.
The founder will ask the investor to give the permission that this is we are planning, these are the terms, right? All of these needs to be communicated to the existing investor
This
who
is
are
affirmative, right? You're saying
correct, affirmative or say the reserve matter.
reserve matter. Yeah, that's what I was
Whatever.
coming to. Yes.
So these are similar.
So affirmative rights or reserve matters are two
same.
separate terms, but they are almost the
Correct,
same.
correct,
Okay.
correct. So in some agreement you may find affirmative, in some agreement you may find reserve matter. Both are same. The meaning is same. Right. So investor wants to reserve some right with him, right? So that the founder cannot do the decision on its own.
Understood.
Yes. So yeah, these are the basic rights which you may find in any sort of agreement.
Yeah.
Apart from this, additional right like non-compete, non-disclosure, indemnity, arbitration, right, disputes, all of these are the standard clause, but yeah, important ones. Usually people skip all of these clauses, right? But these are also the important clauses. So it also needs to be drafted in a very well manner.
Interesting.
Yeah.
So
One more point.
yes, please.
Yeah. So, I mean, when you are finalizing any SHA between founders and investors, I think the principle should be Murphy's Law. Whatever bad can happen will happen. I mean, you should assume this and then proceed accordingly. So, if you want to leave out some clauses, it's up to you. You are just thinking that probably they will not get triggered at any point of time. But believe me, as I said, whatever bad could happen will happen. So proceed like that.
Interesting. So before we proceed, we have people who have joined us online. So I'll request if they can put a one-line introduction in which city or state they are joining from. And if they have any questions, they can put it in the comment box. Just going a little off track and a disclaimer for the audience sitting here that all three of us, none of us is a lawyer. So whenever you're going into any such of discussion, do take a proper counsel from a legal counsel. Which brings me to an off-topic question here that I've seen founders going around to minimize the cost of funding, right? And then in that case, what is being explored is who can prepare this document at bare minimum cost. So I do have my take to this, but I would love to hear your thoughts that what should a founder, investors of course are very experienced. They know whom they want to bring on board and they have their reasons for it as well. As a founder, how should I create a balance? Which is the right legal resource for me to create this? Of course, all three of us know how it can be created, but yet we work with n number of lawyers and law firms. What are those key factors which a founder should consider when kind of bringing a legal counsel on board or a lawyer on board for this?
It's more for your domain, but
so again, it depends upon the round, right? If you are doing say friends and family round, correct? So you may hire some say consultant who has been not say a big law firm, right? Who can do talking from the founder's point of view, right? Where the founder also needs to raise money, but also wants to save that money, correct? So founder usually look for the practitioner, say the general practitioners, not for the law firms, who can basically do everything.
Right.
They can create an agreement for you. They can do the valuation exercise for you. They can also do the compliance set of you, right? So again, it depends upon the round. So when you go to a bigger round where the VC coming on board or say the financial institution are coming on board and investing, right? So they have a standard mandate or say the standard requirement, right? They will also bring their law firm, right? The founder will need to bring the law firm, and there is no option with the founder. So he'll need to spend that money. He'll need to spend that amount for the DD or say for the agreements to be drafted. So there are no say the midways or the sideways where the founder can follow because the mandate is coming from the investor. Yeah.
So I'll throw in my thought. Maybe Nitin, you can go first. Yes.
So again, this problem, or it's a problem if you consider it as a problem. it is basically a trust system,
Hmm.
right? Let's say we work with a founder and we deliver good results to him. Now, automatically, he would build some trust on us. He would probably would like to continue with us, for the next round also. He will give recommendation in his own circle. That trust builds up over a period of time. So, as Akash rightly pointed out, it's a in the initial phase, it's more of a cost and benefit analysis. In the next stage, it is more about whom do you actually trust. Coupled with your own general understanding of how things work. I mean, you should not leave everything to your lawyers.
Mhm.
You should have your own understanding of how these legal terms are going to impact you. So I won't put my money, I mean, I would not follow lawyers' advice blindly. I would have my own, considerations while finalizing these agreements.
Interesting. So I'll leave this discussion in a point with the dilemma that I have. Maybe somebody online or sitting here might have an answer to it. I always thought negotiation was a point where people always relied on various legal counsels. That who's a good negotiator, because on the other side also is a legal counsel, and they're negotiating to balance out both the agreements on both sides. Interestingly, my own experience over the last few years says that despite of who's sitting as a legal counsel or financial advisor across, primarily those who've set up the tone for negotiation kind of again come back whenever the legal counsels are disputing. It is these two folks who, like you rightly said, trust, right? It is these two folks who trust each other who get together and say, okay, we've discussed, now you put it in the agreement. So I've always thought negotiation was the key milestone, or I would say assumption based on which a counsel is selected. But like you rightly hit the nail, where is the bridge of the trust? I think those are the decision makers, and that's how the things start churning out.
So as you said, don't leave these commercial terms to the lawyers.
Absolutely, with the nail.
You should finalize the commercial terms and let the legal team handle the nitty-gritties of it.
Mhm.
There could be some issues regarding, as Akash pointed out, some reserve matters. Now there could be a question about how the founders or promoters remuneration would be decided. Let's say there are two founders and they want to decide how much they are going to be paid from the company. Now it's a reserved matter. These two lawyers sitting across the table, they might have a kind of deadlock there. So you as a founder, because it's in your interest to get the deal closed.
Absolutely.
Right. I mean, they also have some interest in that. They will also get paid when the deal is closed. But at the same time, it's you who's driving the negotiation. Take control of things.
True. Take control of things, I think, is the key sentence here. So let's proceed ahead on the definitive documents. So we've talked about a lot of quality, board seat, observer, offer, preemptive rights, Pro-Rata. I've understood as an investor. Now let's come on to things which affect cap table, because it's masterclass on cap table. So far, we've brought investor on board, price is decided, shares are decided. But probably we've seen complexities around different instruments being used. So before we begin, I was looking at the Excel sheet that was being shared, Nitin. Do you think a basic Excel training is enough for creating these cap tables, or do you think, no, this is very rocket science and this needs a lot of hand holding?
Nothing is rocket science. I mean,
Yeah.
Looking at SpaceX, I don't think
Absolutely.
it's as difficult.
Good example.
So I would say a basic understanding of Excel is required. And beyond that, you should also be appraised about, and you should also be kind of in line with what legal terms have been used, which have an impact on cap table. So, for example, to begin with, the first clause that would be there in your SHAs would be about ESOP pools. We will discuss this in detail later on, but investors would insist on having some kind of pool in your cap table. When I say pool, it means that company is not issuing shares right away. They're setting aside certain number of shares for future use. They will issue these shares to employees in future, but they're earmarking. They're keeping these shares aside for future. Right. Question would be why investors are interested in creating ESOP pool? The answer is simple. Investors don't want you to be greedy. Investors want this company to succeed, and they understand that company can only succeed when promoters along with employees are aligned. I think in last session also I talked about incentives. The world works on incentives. So if you're leaving every penny on the table only for the founders, then employees' interest is not aligned with the company's interest.
Absolutely.
That's why investors insist on having this ESOP. This is first commercial term that would be there, which would have a direct impact on your cap table. Anyone who is on your cap table is going to dilute your shareholding. So would be these ESOP pools also. Right?
Got it.
Another term which is going to impact your cap table, later on would be your liquidation preference. I think we talked about liquidation preference in last episode.
Yeah, we did. Yes.
But let me just, do a recap on that. Liquidation preference simply means what happens when the company goes down, right? And there is some amount that has been recovered from the final sale. To whom this money, belongs to. So liquidation preference simply would mean that the investor who has put in money would take the first share of that proceed, and if anything is left, then the equity shareholders or the founders would partake in that. Right? So that's another commercial term that would be there. Apart from that, there would be ROFR and ROFO. Akash is already covered. Now I'm going to talk about the floor and cap. So I think we talked about convertible notes in our earlier session.
Yes,
right?
we did.
And I think the rationale behind convertible notes was both the parties, founders as well as investors, they're not sure about the valuation in the initial phase. You are at a pre-seed stage business where you just have an idea. You don't know how the market would react, where there would be a product market fit, whether your product would be taken positively by the market, your pricing power, competition, regulations. You don't know anything. You don't have anything on the ground. It's just an idea, right? So at this point of time, you are asking someone to put, say, 50 lakh rupees for 5 crore valuation. Probably they will not agree to it, right? In your mind, you are selling these shares at a very low price. In investor's mind, it is other way around. He is thinking that he is taking a very high risk. We don't have anything on the ground yet. So why don't we, keep this issue of or question of valuation aside for the time being? So what they will do, they will say, okay, this is a kind of convertible round. We are not fixing the valuation right away. We will pack this valuation to the next valuation round, next funding round, which is in common parlance is known as price round. A round in which share valuation is already fixed is known as
Price round.
Right? Now, investor has put in 50 lakh rupees. We have not decided how much percentage he will get. Let's say we use that money, we build a product, MVP is there, we are going to the market now, and we are going for next round of funding. In this round, we are raising 1 CR. We are raising 1 CR, say, for 10%. What does it mean?
10 crores.
It means a post-money valuation of 10 CR. Now, these earlier investors who have invested 50 lakh rupees, they will say, okay, convert my shares in the next round of funding. But do you think that the valuation for the earlier round should be same as the valuation for next round? No, because you took a higher risk.
True.
You came in the picture when nobody was there.
Absolutely.
You helped us in creating this MVP and all those things. So you should definitely get a better deal than the next round of investors. So we will give you a discount on next price round. So we will say, okay, if the next price round is 10 CR post money, we will convert your shares, say at 70% or say 60%, depending upon how much time has lapsed since the last round. Right? So I think you're with me on this, right? So we would have a conversion of earlier securities in the next round of funding. But at the same time, to protect both the investors and the investee, that is company, we would have some kind of floor and cap on this valuation. What happens when the next round of funding is not at a higher valuation that you were expecting, or it is very low, as compared to your expectations? In both the ways, we would put some cap and floor on the valuation. So we would say, okay, these shares, these convertible securities will get converted into equity, at 70% of next round of funding. At the same time, it cannot go below 5 crores. And it cannot go above 8 crores. So that 5 crore is known as floor and 8 crore is known as cap. Till the time your valuation is between these two numbers, it's fine. If it is lower than 5 crore, then obviously your shares will get converted into at 5 crore valuation. Other way around, if your valuation after discount is coming out to be say 9 crore, then also your share will get converted at 8 CR valuation. So I mean, you can imagine to whom this is benefiting. Floor is for the benefit of company and the founder. Cap is for the benefit of investor.
Investor.
Right? So these are basically other commercial terms which could be there.
Interesting. So you're saying that if I don't want to price my round, it's a possibility.
Yes.
I can say, in my case, I was investing 50 lakhs. He said 5 crores, I said 2 crores. And then we came to a conclusion. Let's just talk about valuation in the next round. But because I'm investing today, I won't, of course, invest at the price of the next round. So एक काम करते हैं, bracket बना लेते हैं, floor and cap. Lower one is floor, upper one is cap. कि अगर कुछ नहीं होता तो I'll get converted at floor, right? If something happens, then we'll check the parameters, whether it is between floor and cap, beyond cap, or below cap. And then accordingly, some rate of return would be decided. Very interesting.
And there may be one more question which may come up, right? Whether these floor and cap, so there may be some round where is it mandatory to have floor and cap both?
Okay.
Yeah. So like Nitin has mentioned, right? Floor is for the founders in the company,
Which is mandatory then.
and the cap is basically for the investor.
Right.
So if we talk about from founders' point of view, yes, you should have floor as well while you are giving cap to the investor.
Interesting. So let's just again come back to compliance bit. So cap table, of course, in our case, we are continuing with the example. 50 lakhs I had invested. We saw the cap table. Maybe you can shift to the cap table tab. Now there is another investor who's come in. Again, convertible or CCD round, floor and cap table has started shaping up. Now it says 2 founders, 1 previous investors, 1 new investor, and then the ESOP pool. All we are saying is it's not a priced round, but we've come across nuances that, okay, you are raising CCD and then you also have a floor and cap. Do you need a valuation report still from compliance standpoint?
For the debentures, so again, they can be issued in the convertible round, right, where the valuation report may not be required, and they can be issued in the price round also.
No, in this case where I'm saying it's not a price round.
Yeah.
Instrument is CCD.
Yeah.
Is valuation report mandatory? That's my question to you both.
It can be skipped if there is no non-resident investor.
Understood. So we have gone one level deeper in terms of
Yes.
compliances.
Yes.
But say all Indian investors, then CCD round, if it
CC
is not priced, you can skip the valuation report, is what we are saying. But if it's a non-resident investor, we might still need it because then RBI comes into picture.
That's
and all.
correct.
What happens in case when I change the instrument from CCD to CCPS? Do I still need to, can I still avoid the valuation? But
Yes.
now
The rule is same
so if we are raising CCPS,
with the convertible terms.
convertible notes, floor and cap.
Floor and cap.
So I don't even need a valuation report of the floor.
Yes.
But why are there cases where people are taking the valuation report at the floor price when they are doing such rounds?
So you understand.
I've come across some cases where, and that's the anomaly that even I am looking at from compliance standpoint, where fraternity members have different viewpoint. If it's a convertible, I have not priced it today, but there's a floor and cap. Why do I need a compliant valuation report from compliance standpoint, and why is it done at floor price?
No, you don't need a report, but why it is coming? So you don't need a report, right, for the compliance standpoint of view, unless you have some non-resident investors where the FEMA guidelines or say price guidelines are coming into the picture, right? But when you are raising from the residents one and then someone is asking to you for you to get a valuation report when you are doing a convertible round, so I think either it is by it's an investor mandate, right, or maybe
It's more from a governance standpoint.
yeah, that
law is not asking this.
the law is not asking, because otherwise if you have the valuation report, then why you are doing the convertible round?
Interesting. So you talked about preemptive and pro-rata. I've also heard of a term called anti-dilution. So what is anti-dilution, Nitin? How does it work, and what does it have impact on cap table management?
So anti-dilution is a very standard term in any SHA. I mean, you will find anti-dilution in all the SHAs that you're going to come across. Anti-dilution simply means, let me again give you an example. Let's say today you buy an iPhone, say for 1 lakh rupees. Very simple. Now, very next day, you you're going through the same road and same market, and you see a board where the same shopkeeper is now offering same iPhone for 80,000 rupees. My question to you is, how would you feel? You bought the iPhone for 1 lakh rupees, and now shopkeeper is selling the same iPhone in the very next day at 80,000 rupees. You will feel bad about it. Not exactly
Not
cheated,
needed.
but you will feel bad about it, right? Especially when your friend is buying same phone at 80,000 rupees. And you would say, सबसे पहले मैं ही आया, मैंने ही तेरी बोनी करवाई, and then I ended up with a iPhone of 1 lakh rupees. The same happens in investors' case also. Let's say, continuing with the same example, let's say he invested in my company at 10% for 50 lakh.
5 lakh, 5 crores.
5 crore valuation. Now, what was his expectation? His expectation was that I will become the next Swiggy or Zomato or something, right? His investment will also yield 1,000x return. He may simply close down his office and for not to work, for any remaining days of his life, right? These are all his expectations. But things don't work like that, right? I'm not Zomato founder, right? So I use his money. I created the app. I'm doing the business, but somehow things are not working out like I expected. But I still need money for the next round, right? Now, after say 6 months down the line, I again go to the market for further funding round. Say this time around, I'm raising only 25 lakh rupees, and he has come to my rescue. He is willing to put in 25 lakh rupees for 10% of the company. So the question would be, he bought the same shares, 10% of the company at 50 lakh rupees, right? And he is now getting the shares, same 10% in the company at 25 lakh rupees. That means a post money valuation of 2.5 CR. Now, how he would feel about this? He will feel bad about it because he bought the shares, he took more risk, and he ended up with a lesser percentage of the company at a higher valuation, right? So to protect his rights, I will, as part of my SHA, will give him some kind of respite in that, some reprieve. So there could be different type of anti-dilution protection where I will increase his shareholding. The company will issue more shares to him to compensate him for the loss that he has suffered, right? There could be different type of mechanisms to it, but that's the gist of anti-dilution protection.
So I typically get shares for free.
You don't get shares for free. You have already bought the shares at a higher price. Company is compensating you slightly for the risk that you have taken.
So I get new shares.
You get new shares. Technically he bought the CCPS, right? Which was supposed to be converted into one CCPS into one equity. But because of this down round, we call it as down round, where the valuation has gone down. Down round, he would get, say, 1.5 equity shares for every CCPS he's holding now. So your conversion ratio would change.
But how it will change if I have equity shares already with me?
So that's a one point. I think we covered that last time. Why investors prefer CCPS? I mentioned two reasons for that. One of them was liquidation preference. Second one was, if you remember, it was liquidation preference was one. Second was anti-dilution.
Anti-dilution.
Right. So that's why you should not, as an investor, as a seasoned investor, you should not buy.
So if I would have taken equity at 5 crores and now he's raising money at 3 crores, I get nothing.
You will get nothing. Unless, you have some other arrangement where he issues you further equity shares at face value.
Trust and integrity.
Secondary
transfers.
Or since you are friends and family, we call it as fools and family also. So, by investing in equity, you are out of this anti-dilution thing.
Understood. So we talked about liquidation only.
Yeah.
You heard terms like weighted average and full ratchet. Maybe you can just throw in some light of what are these methods, why are they used, what is the investor preference, where is it used?
Okay. So let's
and maybe
continue.
If you want to show something.
Yeah. So let me take you through an example. Excel probably will not. Excel is too complex to understand now. But you will take you through the same example. Let's say he invested 50 lakh rupees for 10%, 5 crore post money valuation. Next round of funding is happening at 2.5 crore of valuation, and he is putting in 25 lakh rupees for 10%.
Yeah, let's assume. Yeah.
Let's assume, yeah. Now, if that happens, if he's getting 10% of the company, your shareholding automatically will, from 10%, it will become 9% now.
That's correct.
And what is the company's valuation? 2.5 CR. So what is the value of his stake now? Your stake value would be 9% of 2.5 CR, which is like 24 lakhs or something.
Yeah. So my 50 lakhs is now
24 lakhs.
24 lakhs.
Right. So he's not happy, right? Now we need to compensate. So in what manner I'm going to compensate him? One of them could be full ratchet. Full ratchet simply means that his stake value should not go down. That means if the company's valuation is 2.5 CR, your stake value was 50 lakh in the initial phase, you should still be able to have 50 lakh rupees as stake value. What does it mean? It means that you should be holding 20% of the company now.
Okay.
Instead of 10% earlier, your shareholding in this company should be 20%. So that 20% of 2.5 CR is still 50 lakh rupees, which you invested. So you're not worse off, you're not better off.
So it's almost parallel to anti-dilution in that case, is what you're saying.
No, it's an anti-dilution only.
Okay.
I'm saying it's a kind of anti-dilution.
Understood.
Here I am compensating you fully. Right. So I will increase your shares. Technically, I will double your shareholding in the company, so that you still have the same value of stake.
So if I have CCPS, my conversion ratio will change.
Yeah, your conversion ratio probably would double. I mean, in this case, it would double.
Got it.
Right. So that's one way of compensating. This method is known as full ratchet method, where his stake value will not go down. I will give him as many shares, as part of this conversion process, so that his shareholding value is still same as as the first round. Right. Another way of compensating could be, which is known as weighted average or broad-based adjustments. In broad-based adjustments, we don't compensate the investor fully. We drive a formula where we look at the ratio of new issue price and the previous issue price, and based on that ratio, we compute a multiplier, which would be applied to the existing shares. So you would still get higher number of shares on conversion, but not, as we were offering in full ratchet method.
So as an investor, I'll always want full ratchet.
As an investor, you would like to have full ratchet, but think of it like this. If you are an investor who are there only for one deal, then it's fine, right? But if you want to run a shop, where you want to have regular flow of deals to invest, good founders coming to you for funding, then you would like to project yourself as a founder-friendly investor. Full ratchet does not serve your purpose then. That's why practically whosoever is putting money and he is a seasoned investor, then you will see a broad-based weighted average adjustment, right? Instead of full ratchet. Because if you are offering full ratchet, then automatically founders' shares will go down. He would still have his 10%. 20% he would have. I'm left with only 70%. So that 10% loss is coming from founders' pocket. So investors, if they are, seasoned one, they will not go for full ratchet. They will probably go for broad-based weighted average method.
Interesting. So we have 5-7 minutes left. We've covered very vast topic, but maybe I'll just go back to one point to summarize, which we have already done in the last call as well.
Yeah.
So after all this that we have done, so founders came together, raised first round, did ESOP pool, raised new round, did the legal agreement, brought all this pictures, Pro-Rata, preemptive, liquidation, anti-dilution agreement. Now at the end of that SHA, there is one document called cap table is what we are discussing. We talked about fully diluted cap table. Maybe we can just summarize today's session and let's just throw your knowledge nuances on the cap table that we see on these SHAs. Are they always fully diluted, or there are various types of cap table that are on these definitive agreements?
So generally, as part of annexures to these SHAs, the cap table, the pre-money, that is cap table before the investment and cap table after the investment would be given, and they would generally reflect the full dilution ownership of the company.
Understood. So it will always be fully diluted, assuming that conversions have also happened.
Right.
Then how it will look like.
Right.
Akash, in your experience, have you looked at anything else? If maybe I'm missing onto something, but does the definitive agreement always have fully diluted cap tables, or they also have any other form of a cap table?
No, they'll have the fully diluted cap table only.
So,
Investor wants to see the percentage on say fully diluted basis.
so unlike a signed financial statement, it's per Schedule 3, which says types of instruments, who's holding what kind of instrument.
Also, your cap table in the financial or in your books can be different from the cap table which are in the say these agreements.
Yeah. So if as a finance professional, as auditor or the ecosystem player, if you want to read financial statements, we might not have access to the fully diluted cap table per se.
What?
Then as a ecosystem player, how will I be able to decipher a cap table when I'm looking at, does financials have all these terms as well? Or I will need to have to go to the MCA website, download all these definitive documents because they will have to be uploaded. If I'm not wrong, these definitive agreements, once the round is closed, will we find them on ROC website or not?
Yes, you will find all of these documents as a part of the resolutions, but not the full agreement. You will not be able to find full agreement.
Okay, so in case what I'm trying to summarize is, if I want to look at these terms, if a round has been closed, I can go back to the ROC website, pay 100 rupees, download the documents, look at the financials. If it is post year end closure, look at those documents, and then I can prepare a fully diluted cap table to ascertain how does the cap table look like.
You will have to make those efforts to basically have that cap table
Right.
as an outsider. You will not find it in say in the public domain.
Interesting. So any closing notes? I think we've covered a fair bit of technicalities today. Not much of an Excel sheet, but like we've discussed, it would be too much for an hour discussion to show. Happy to take feedbacks from those who are online. We can drop in our email ID on the comment box. If anybody wants to have a detailed conversation around any of this point. We will cover up ESOPs in our next episode. And with anti-dilution, I think another topic that's throwing out is taxation and all this, because we've yet not discussed famous side of the story yet. We had angel tax, and then the angel tax got abolished, and now again there are nuances around Section 56. So I think maybe we might extend it to the 4th episode also.
And another topic that I think probably we need to discuss is the advisory shares. There is a lot of things happening on that front. People are not aware of how to give advisory shares. It is similar to the same problem that co-founder has.
So we have SAR in our next episode. I think we are going to cover the advisory part there.
Probably.
How private limited companies can give shares to consultants and advisors.
Right.
And is that even legally valid? So we'll touch upon it in the next episode.
Right.
Next Friday this month only, potentially last week.
Right.
But we'll have that update coming on LinkedIn. So thank you for joining online. We'll stop the live here. Thank you both.
Thank you.